It is Friday, December 6th, 2019. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was very interesting get your ass kicked at Jiu-Jitsu Friday, mostly because this was like the least amount of Jiu-Jitsu I've done in a week in, I couldn't even tell you. I think I had 2 classes this entire week, and normally I'm like somewhere between 4 and 6. You know, if I've gotten extra ambitious and did that 2 a day on what was it, Monday, or just done a 2 a day somewhere else. But yeah, typically I get in about 4 days per week. This week, no. I don't know what it was. Things just misaligned and whatnot. I do know what happened on Wednesday. We didn't actually have class. And it was funny because I said on the show on Friday, or I'm sorry, Monday, that I wouldn't be here on Wednesday. And just to let you know, I probably won't be here next Wednesday either. I do have something that may be coming up. I will do everything possible to notify you either way. But anyway, so yeah, Wednesday, or Monday had said that I wouldn't be here on Wednesday. And it was funny because I thought there was this meeting that's going to be happening next Wednesday, possibly, I think so, last week. But it did not happen last week, or this week rather. As a matter of fact, something else happened though. It turns out that last night was promotions night for my jiu-jitsu class, and there was no class. That's why there was no class. And so now I am a 2nd degree blue belt at my gym, feeling very, very happy to have finally made another step up. And I'll tell you, I can feel the difference. And it's funny, I asked pretty much every one of my instructors that is typically there to instruct, what was there anything in particular that you noticed that you didn't see in me in my game last time? And it was pretty much unanimous that I was putting together stuff a lot smoother, and it just seemed like my game was a bit more together. And honestly, that's kind of how I've been feeling for like the last month or so. It seems like the additional effort is starting to pay off as far as my dexterity and my progressions go. And so today when we did a little bit of positional sparring, and it was pretty easy. I tried to take it easier too. Instead of initiating every action and making every mistake myself, I figured I'd let my opponent do a few of them. So as far as what we're going to throw down for music, just to let you guys know, I did get some new music, and so we're going to be playing a little bit of that today. But you know where we're going to start off with a little bit of body count for you here on Coin Metal. As far as our first dance, talk shit, get shot. First dance here on Coin Metal. And that was the Block Dahlia murder with Bringers of the Night, Nightbringers. So, as far as what we're going to get into today, got a lot of interesting stuff here, and kind of wanted to start off with something to do with fiat. I like to transition back and forth because, it's one thing for you to understand that you can use Bitcoin as money. It's another thing for you to understand it as an entirely separate currency. And this is a conceptual bump that a lot of people have trouble with. I was listening to Jimmy's song earlier in the day, and that goat roper still doesn't have anything really terribly interesting to say. I'm sure he knows something about code, and I'm sure he knows how to write software and stuff, and I'm not terribly proficient at that. As a matter of fact, I don't really write code. I've made attempts. However, the problem that I had with what I was hearing is he's talking all this smack about altcoins. And the problem that I had with a lot of his reasoning is that the the objections that he has towards altcoins are basically the same objections that someone would have to Bitcoin from a purely fiat standpoint. So, say they're a user of fiat. They have fiat in their pocket. They earn their money in fiat. They're happy with fiat. When you're trying to describe to them the proposal with Bitcoin, and you tell them straight out, you don't even have to give up your fiat if you're using Bitcoin. This is just another monetary unit, another currency that you could be putting your monetary value into, or using to transact your monetary value and store it. And so the problem is that most people don't give it that kind of explanation. And I think the reason they don't is because the next logical progression is, after you have come into Bitcoin and you do have some monetary value in Bitcoin and you have made an on-chain transaction and you are familiar with the entire process, that you start saying to yourself, well, that was cool and all, but it was pretty fucking expensive. Are there any cheaper options? Well, and you start looking around and there's altcoins. And I believe it's because there are individuals and groups of individuals in this space that want us to use cryptocurrency in a way that it wasn't really designed to do, wasn't really intended to. And I think that over the longer term, we're going to find out that the vast majority of people simply don't. And it's not going to be any different for the US dollar as it will for any other currency out there. So anyway, here it is. It's on, first one I got here is on zerohedge.com. It's by Tyler Durden. Oh, wait a minute. It was originally authored by Colin Lloyd. What? Yeah, we're not going to do that. Yeah, here we go. This is on AIER.org, and I don't know if I actually read this before. I don't think I have. But this is by Colin Lloyd. The Giant Debt for Equity Swap. Since the mid-1990s, the number of companies listed on the U.S. stock exchanges has been steadily shrinking. There are currently just over 4,000 companies listed, up from the 2012 low, but way down from a peak of more than 8,000 in 1996. Europe has not been immune. Only 84 companies have listed this year, the lowest in a decade and the lowest by deal value since 2013. European capital markets have always been less equity-centric than the U.S., but even here the number of listings has shrunk by 29% since 2000. In the post-financial crisis period, three factors have driven the retreat of listed equity. The rise of private equity, an industry that is estimated to be sitting on more than $2 trillion in capital, awaiting new opportunities. The slower pace of new companies launching on public markets due to the availability of private venture capital and mergers of existing listed companies. Behind these factors lies a more powerful force: artificially low interest rates. In a low interest rate environment, the appeal of debt financing increases relative to equity. This seemingly benign influence has profound implications for capital markets and the economy more broadly. By means of debt finance, earnings per share can be enhanced without the need for productivity gains. For the executives who direct those companies, the incentive to borrow externally rather than improve internally increases as debt financing costs decline. Conversely, in a rising interest rate environment, these same executives are incentivized to improve the internal efficiency of their enterprises. To this extent, higher financing costs can contribute to improved productivity. Financing costs have generally been falling since the 1980s. During this same period, executive compensation, especially via the award of stock options, has risen dramatically. Owning call options gives an investor a different incentive from a stockholder. The option holder's preferences for capital over income. High dividends directly reduce capital revenue. Executive holders of stock options favor lower dividend payouts and higher earnings per share. Falling interest rates have also impacted income-seeking investors. Faced with declining returns from fixed and floating rate investments, these investors have been forced to accept higher risk in the form of increased duration, greater credit risk, or leverage. Duration risk is unique to fixed income investment. All other things equal, the longer the maturity of a fixed rate bond, the longer the duration, and therefore the more sensitive the price to a given change in the yield to maturity. As short-term interest rates have approached zero, the normally upward sloping yield curve has flattened. In developed markets, this has been exacerbated by the central bank policy of quantitative easing. By this process, some investors are forced to look elsewhere for returns, like cryptocurrency. In the return from extending the duration of your portfolio has diminished, an alternative source of yield can be found by the purchase of less credit-worthy debt. The insatiable investor's thirst for yield has been quenched, at least in part, by private equity, venture capital, and leveraged buyout funds that have securitized their borrowings. Demand has also been met by a wide variety of corporate borrowers, many of whom issue debt simply to fund share buybacks. This debt may take the form of fixed or floating rate bonds or loans. For a small group of income investors, the alternative to fixed coupons or floating rate notes is the outright purchase of equity. In relative terms, this alternative has disappointed. Income stocks have generally underperformed growth stocks during the last few years, in part because capital appreciation pushes stock prices higher, which attracts momentum investors. A strong influence, however, is lower interest rates, which make higher price/earning multiples more manageable. In addition, low rates encourage expectations of lower returns. They also make investors more fee-conscious, favoring index-tracking products over discretionary funds. Where are we now? To recap, the breadth of the listed stock market is in long-term decline. Debt finance is cheaper than equity finance. For corporate executives, share buybacks are preferable to capital investment. Corporate debt levels are at near all-time highs. The credit quality of the outstanding debt is deteriorating. Further cause for concern is the changing makeup of the debt. While corporate bond issuance has been growing, the corporate loan market has been in the vanguard of the expansion. The chart below shows the changing relationship between bonds and loans. Gives us a nice chart there. The level of debt relative to GDP may be at new highs, but the cost of servicing the debt interest is relatively low due to historically low official interest rates. The real risk in a recession is that credit spreads widen even as official rates are eased. As growth slows, U.S. Treasury bonds may reach new highs, but lower-rated bonds and loans will still be sold. The credit intermediation process relies on the banks continuing to lend, but banks are notoriously cyclic, pulling in their horns just when they are needed most. I think I have read this, and yeah, I'm not going to finish the whole thing. We did read this before, so sorry. It took me a little while to figure it out, but yeah, it was an interesting review of the composition of U.S. debt and how it's changed over time. Yeah. Anywho, where I wanted to go next here is on Cointelegraph. And this one's by William Suberg, so yes, penis. And this one was authored on December 2nd, 2019. OneCoin website goes offline as net closes in on $4 billion Ponzi scheme. The website for cryptocurrency Ponzi scheme OneCoin has finally ceased operating months after the United States authorities indicted one of its founders for fraud. As MLM scam monitoring resource behind MLM.com noted on December 1st, OneCoin.eu no longer returned a live result as of November 30th. Quote, or legal investigation offlines OneCoin.eu. Upon investigation, a representative from URID, the domains registry, confirmed to the publication that the website was offline due to the criminal proceedings against OneCoin. Quote, the domain name is under legal investigation. Please further check our whois for the status of the domain name, the written response reads. The event marks the latest in a series of revelations in the takedown of OneCoin, which operated for years and defrauded investors of around $4 billion. As Cointelegraph reported, the legal case last month closed in on a lawyer associated with co-founder Ruja Ignatova, who prosecutors claim is responsible for helping her launder proceeds worth $400 million. Holy shit. Scams remain Bitcoin buzzword. OneCoin first attracted suspicion as far back as 2015 when Cointelegraph released an expose on the back of research from behind MLM. In the ensuing years, successive governments worldwide issued warnings about the scheme's operations, which promised huge returns for comparatively tiny investments. Ignatova is currently on the run, while her brother, fellow co-founder Konstantin Eigentov, my apologies here, recently pled guilty to charges including money laundering and fraud and faces up to 90 years in prison. Holy shit. Controversy continues to swell around another cryptocurrency project this month. The creator of altcoin Hex, Richard Hart, attracted widespread accusations of foul play after making various promises, including free tokens, to Bitcoin holders. Hex describes itself as, quote, the first high-interest paying blockchain. Oh, shit. Man, I've kind of stayed away from Richard Hart because I read their I think I read his white paper for Hex, and it was pretty clear to me up front that it was kind of bullshit. Let's see here. I found a thread here on Twitter concerning this Hex business, and let's see here. Just reviewing it a little bit here. Oh man. Yeah, crypto Twitter is not fooled. Abra tweeted here this flashing meme that says warning, or flashing GIF rather, that says warning, this person is a scammer. Yeah. I don't know that he's a scammer. I didn't see anything about Hex that looked like a legitimate project, honestly. But yeah, let's dive into that a little bit here. Speaking of scams. And so yeah, this is on Cointelegraph.com. It's by Darren Klein. And this is authored on December 1st, 2019. What the hex? A look at Richard Hart's controversial new crypto. Hex is a new financial tool and cryptocurrency launching on the Ethereum network via a Bitcoin UTXO snapshot on December 2nd. Critics are questioning Hex's legitimacy, calling it a colossal cash grab and privacy compromise. Devout fans can't wait to claim their tokens and start staking. So who's right and who's wrong? Richard Hart, the outspoken man behind Hex, sat down with Cointelegraph to talk about the upcoming launch and counter a few of the criticisms surrounding the project. Hart explained that Hex is the world's first high-interest blockchain certificate of deposit, CD, letting users stake their tokens in return for interest. Users can enjoy interest payments ranging from 3.69% if 99% of the total supply is staked, up to an improbable and enormous payout of 369% if only 1% of the total supply is staked, paid out in Hex tokens. It's worth noting that the monetary value of such a payout depends entirely on the market value of Hex at the time of maturity. Quote, it's the world's first blockchain CD that attacks the largest market in the banking ecosystem outside of savings accounts, Hart said. Move over, big banks? Hex is essentially a crypto version of the traditional fixed deposit. The client side looks like the popular banking instrument. A user locks up funds and then receives their invested principal plus interest when the term matures. Quote, banks use your money as a sort of collateral that's just an excuse for them to borrow money from the government at extremely low rates, Hart said. Hex fixes this. Meanwhile, Bitcoin has some serious limitations, Hart explained. Quote, what does Bitcoin do? It lets you enter a number on your screen, which changes the number on someone else's screen. It makes sure nobody does that twice by burning millions of dollars in electricity. Of course, the cost to secure a single such transaction is far from millions of dollars, but Hart has a soft spot for hyperbole. Hart said that Bitcoin prices can spiral downward due to minor competition, causing difficulty to spike to some all-time highs while the market price dwindles. Miners have to keep selling more of their newly minted coins and thus continue to push the price further down. Hart neglected to mention Bitcoin's difficulty adjustment system, which finds an economic balance between mining costs and monetary rewards. Rather than losing against inflation, Hex users earn it by locking up coins, Hart said. People are competing against each other for larger and longer stakes, starting as early as possible, in order to get a larger piece of the profits. If you end your stake early or late, he said, you're penalized. Only users who don't lock their coins suffer from inflation, because they're not letting the rest of the world know when they will sell them. Quote, "It's a truly unique system. It's the first of its kind," Hart beamed. Hart complains that Bitcoin's system still has critical bugs that aren't solvable by wasting more electricity. Quote, "Bitcoin's security model burns millions of dollars, but starves developers of money, has no security audits, and no bug bounty." Hart continued by pointing to the decline in wider Bitcoin adoption. Quote, "Fewer people accept it. It has fewer addresses, fewer Google searches, only minor upgrades besides SegWit. Lightning only has $6 million in total and also has critical vulnerabilities from time to time." Hart explained that Hex solves these problems. Quote, "It does everything Bitcoin does but better, except liquidity, but that's because it's brand new." First, Hart pointed out that users can profit from referrals. Secondly, lending BTC in the hopes of making interest requires trust, whereas Hex does not. Hart said, quote, "To earn money on your Bitcoin, you have to lend it to a counterparty and hope that you will ever see it again. With Hex, you lock it in a smart contract. It's in its trusted or trustless interest. This programming is secure," he explained, "since the consensus code that controls the inflation and validity of the coins is locked in a smart contract. Developers can't accidentally generate a bug," he said. Quote, "But in Bitcoin, if you try to improve the network anywhere, your changes touch the consensus code. That's how the last inflation bug got accidentally put in there." Hart compared such a change to upgrading an airplane's software while it's in the air, a dangerous, difficult task. Yeah, that's why it's usually really, really good to qual test your shit in a sandbox environment before you distribute it out to the wider public. Continuing on, 10% of the world will hate you. Many criticisms aimed at Hex focus on Hart's potential to make the lion's share of profits from the scheme. The origin address, an element of the scheme that users are obliged to trust, receives a massive portion of the claimant bonuses. Quote, "Whoever holds the keys to the origin address is going to be happy," Hart said with a chuckle. When asked for his thoughts on Hex, cryptoeconomy podcaster Guy Swan took the question to his listeners. Quote, "I started a thread in our cryptoeconomy Telegram group and it got out of control fast," Swan said. Quote, "I can't believe how this thing is set up. Its core design could make it one of the most prolific schemes to funnel money to a single party that I've seen in the crypto space." Swan expressed further concerns, comparing it to OneCoin and its, quote, "brazen means of exaggerating vast sums, upwards of 2/3 of all invested ETH and Hex supply under a single entity's keys." Swan explained, quote, "To get Hex after the airdrop, you purchase an adoption amplifier, which makes the game out of bidding on new Hex tokens by sending ETH into a pool. Then ETH then goes directly to Richard," Swan concluded. Quote, "Everything in this ridiculous token is designed to look like a game and encourage gambling, but the one universal factor in every game element is that Richard gets wealthier and you get a worthless token that he invented for free." Others have fired criticisms at Hart for Hex's purportedly Ponzi-like structure, as well as for privacy and security concerns regarding its claiming process. Vlad Kostia, a writer at Bitcoin Magazine, presented a range of arguments against Hex's purported legitimacy, calling it a scam back in January 2019 when it was originally branded as Bitcoin Hex. Kostia wrote, quote, Bitcoin Hex resembles a Ponzi scheme. He criticized the project as a sort of, quote, fool's gold, promising to make everyone richer at the expense of a single sign-up process. The writer also pointed to privacy concerns regarding the claiming process. During the launch phase, anyone holding Bitcoin can claim 10,000 hex for each Bitcoin stored in a wallet address. Kostia wrote, quote, people watching the weekly interviews and understanding the process will probably think that they have nothing to lose, but the price to pay is privacy itself, as participants to the Hex scheme willingly reveal to the public how many Bitcoins they own, unless they obfuscate their transaction history with a tool like Wasabi Wallet, that is. Following a barrage of criticisms fired at Hex, Kostia concluded that the tokens will have no value, with gullible traders handing over their valuable crypto gold for worthless stones. Quote, the project uses tactics a scam might use. Hart justified the design of Hex's payment system. Quote, the market sets the price. If no one wants in, the price will be nothing. He took a light-hearted approach in handling critiques of outright fraud. Quote, so there's this trustless thing that people can use or not and pay what the market says it's worth. Or not. Scam! Hart elaborated, quote, I don't care who you are. 10% of the world will hate you. In crypto, there's a tribalism that every coin you buy is a world-changing, amazing thing. Every coin anyone else buys is a scam by default. Yeah, that's a bunch of bullshit. He responded to critics bemoaning his financial success and profit-seeking motivations. Quote, they're closet socialists. They say, quote, I'm poor, so I want you to be poor too. Hart addressed the issues surrounding privacy and security, saying, quote, every hex claim is safe and secure. For extra anonymity, users can claim each BTC free claim to a new ETH address over Tor and click New Circuit after each claim. Hart said, I don't know your IP. I don't know your name. I know the public address that has claimed Hex. It's like knowing you have a front yard and people can see your front yard. He continued, quote, I don't want your data. If I wanted your IP address, I could set up a Bitcoin node and just listen. Or I could buy a wallet company or make an app. It's so stupid. Hart has extremely ambitious hopes for the project, I would imagine so, envisioning Hex, quote, overtaking all other cryptocurrencies and onboarding people in the real world. He explained that the project uses tactics a scam might use, like referral bonuses, in order to attract interest, but offers an honest, real project. There is no doubt that Hart is a master marketer and salesman. He appears to be genuinely passionate about the project, aiming to recreate the early days of free mining. $1 Bitcoin and massive profits for the fortunate few. Exactly how few will benefit from Hex is yet to be determined. Yeah, I felt kind of slimy just reading that, just because I don't want to shed any more light on it than is already there. I don't know. I haven't heard of him directly scamming anybody, but he does seem like the kind of guy that would that would do it because he wants to make money. And while I don't see anything wrong with wanting to make money, I do see that there are much more ethical ways to go about it than creating some bullshit scam coin. It certainly doesn't do anything for the public's confidence in the legitimacy of the cryptocurrency market as a whole, with entities like that fucking it up for everybody else. Anyway, let's go ahead and throw back down into some music. And as far as where to go next, let's go with a little bit of sixth Philistine philosophies here on Coin Metal. Oh man, it fully caught me off guard there. That was Melvin's with Honey Bucket. I almost let it run because it's fucking Slipknot, but you know, I got to come back to reality at some point or another, right? So, the next little thing I got here, it's about our favorite little, what's that term? It's not industry. What's that term? Everybody's wanting institutional. Yeah, there we go. Our favorite little institutional investing portal, which I think is wholly fraudulent, but I believe we'll find out either way soon enough. Anyway, here it is. Bact's growing volume hides an uncomfortable truth. Despite record-breaking volumes, there's very little Bitcoin in play. And this is by Will Heisman. Yesterday, Bitcoin futures... penis. Yesterday, Bitcoin Futures Exchange Bact saw 4,269 Bitcoin, $32.26 million in trading volume in one huge record-setting day. But that's not the full picture. What's exciting for Bitcoiners is that Bact's futures are physically delivered, which means trades are supposedly settled in Bitcoin, not the cash equivalent. In theory, this means more demand for Bitcoin. But it turns out that so far, very little Bitcoin has actually been settled by the exchange. According to trader Alex Kruger, in the months of October and November, Bact has delivered just 32 Bitcoin, worth $242,000 at today's prices for its monthly futures. And its daily futures, just 2 Bitcoin at $15,000. While the monthly futures settlement is a lagging indicator, since they expire a month after the contracts are created, the numbers don't appear to be anywhere near the recorded trading volumes. Kruger said he wouldn't be surprised if 100 Bitcoins was delivered in December, but even this would be just a quarter of what Bact supposedly traded yesterday. Quote, "The more regulated volume, the better. Bact's growth is very positive, yet keep present Bact is not that different from the CME. It's almost entirely paper trading," he said. This is a reference to the Chicago Mercantile Group, CME, which has offered Bitcoin futures since December 2017. In Q3 2019, it averaged 5,534 contracts per day, equal to 27,670 Bitcoin, worth $289 million at the time. However, all of these contracts are settled in fiat money. Even more, Bact appears to be trending in this direction towards cash-settled futures trading. Bact COO Adam White recently said the exchange is working on adding such an offering. Many people believed that Bakkt would help take Bitcoin mainstream, but it might just be a wolf in sheep's clothing. I don't even think it's a wolf. I think it's more like a scarecrow. It's like basically it looks like something that it's not. It looks like it's a person, but it's just a stuffed suit full of hay. But anyway, I wanted to get into this other thing though, because it's not being settled. We've just established that Bakkt typically isn't settling its futures contracts, which its big selling point was that they were going to be settling in real Bitcoin. Okay, that the indications are now that the vast majority of the trading of those futures is not being settled in Bitcoin. So if it's not being settled for Bitcoin on one side, what about the other side? Do they even have the Bitcoin? Well, let's find out. This one's on cryptosyringe.com. Backed Bitcoin futures not 100% backed by physical Bitcoin. And this is by Adminka. Check something really quick here. Adminka. KA or whatever. I don't know. I'm not going to try to attribute genitalia to this one, only because I don't have an actual author name. So this is authored on the 4th of December 2019. In September, after much anticipation, Intercontinental Exchange, that also operates the NYSE exchange, launched the Bitcoin futures platform Bakkt. After a disappointing start with just 72 contracts recorded in volume on its opening day, Bakkt gained momentum towards the end of October. In November, it started making new records almost every day. The latest entrant in the Bitcoin futures market, Bakkt hit a fresh record on November 27th with the volume of 5,671 Bitcoin. Comparing Bakkt's record volume to that of the Chicago Mercantile Exchange, CME Group, the first one to launch Bitcoin futures contracts in 2017, where 1 Bitcoin contracts equal 5 Bitcoin, analytics platform So.com stated that Microsoft and Starbucks Bakkt platform is catching up with the CME. Pardon me. Bakkt's hitting new daily volume records almost every day, reported Skew.com, adding, quote, Bakkt's all-time high volume versus CME was actually reached on November 6th. Yesterday's record is actually quite far, although the trend is clearly positive. It gives us a nice little chart there. However, economist and trader Alex Kruger says Bakkt's no panacea. Bakkt's no different. It's just like CME and other Bitcoin futures exchanges. Given the fact that ICE is behind Bakkt is big in itself, the regulated Bitcoin futures platforms also received a green light from the NYDFS to operate as a trust. But even more exciting was that Bakkt was going to offer the first physically delivered futures to trade on a regulated market. In a Medium post last year, Bakkt CEO Kerry Loeffler explicitly pointed out that, quote, new daily Bitcoin contracts will not be traded on margin, use leverage, or serve to create a paper claim on a real asset. And this is what differentiates Bakkt from, quote, existing futures and crypto exchanges, which allow for margin, leverage, and cash settlement. As such, people believe that Bakkt's volume is fully backed by Bitcoin, but that is not, quote, even remotely the case. almost nobody takes physical delivery of backed Bitcoin futures. For starters, 37% of backed futures are, quote, backed by dollars or treasuries. And there's this tweet here by Alex Kruger. Myth, backed futures fully backed by Bitcoin. Reality, backed futures 37% backed by dollars or treasuries. Let's see here. And apparently this might be off of their user information or whatever. Number 2 are the backed Bitcoin futures leveraged. Yes, both contracts will be leveraged futures and will be margined by ICE Clear US, including the collection of initial margin collateral and variation margin to manage risk. ICUS initial margin for the backed Bitcoin daily and monthly futures is expected to be approximately 37% for outright contracts. Very interesting. This is no big deal and just busting the myth, as Kruger says, but many believe backed futures to be fully backed by Bitcoin, which, quote, is a widely held but false belief. Kruger explains that for backed futures, almost nobody takes physical delivery. However, this is not a problem because it is normal for futures traders to not take delivery in all assets. But backed is no panacea. Stunning how they changed the product and most of the industry didn't even notice, Kruger said. Despite all this, Kruger believes backed will be, quote, hugely bullish someday, while it is currently only slightly bullish. No, I think they are going to get fucked in the ass. If they're operating on margin on where they're trading the volumes of Bitcoin somewhere else, they're going to get fucked in the ass. I mean, I'm sure there's some sort of liquidity dependency in there, and if in the event of something like the halvening coming up, I think that liquidity is going to be even in shorter supply, and so yeah. I think that there are certain rules about Bitcoin. There are certain rules about the way that Bitcoin operates, and as long as those are true about Bitcoin, there are going to be certain truths about it. And one of those is that you either have the coins or you do not have the coins. There is no in between. And I know there's people out there that say they can adjust the current state of the funds, but there's either settled funds or unsettled transactions. That's it. That's it. Period. And people can lie to you and tell you that there are multiple other states. No, we can put it in a suspended smart contract and no, yeah, whatever. They're full of shit. The transaction is either settled or it is open. If it is open, then it is in an indeterminate state, and so whether or not it will fully settle to the intended parties that were transacting during the time that it was open is anybody's guess. And I think that people are just playing with fire out there with this shit. And like I said, backed using margin to trade. If they ever get liquidated, they're going to be screwed. And I imagine that at one point or another in the not so distant future, people are going to start getting really prudent about the way that they're storing their cryptocurrency. A lot of people just keep their coins on an exchange at the moment. But we are going to see people transitioning away from that attitude and start adopting more a personal custodial approach, as these coins were always intended to be used like, And so, yeah, I think that is going to happen, and I think a lot of coins and a lot of projects that have basically pegged themselves to Bitcoin and limited themselves to either living or dying by the way that Bitcoin operates, they're going to end up dying. Because a lot of them are used to the idea of some entity out there like an FDIC or something like that that's going to be able to cover all of their traders, and they're never going to be held fully liable for it because they're not really playing with other people's money, right? Well, that's not the case with Bitcoin. Because there is no central bank out there that just waves the magic wand and prints up more Bitcoin. You either have the Bitcoin or you don't. You know, there's a reason why there's a supply cap of 21 million. And so there can be a full accounting of where the funds are and what the funds are doing. But yeah, so I think that in the not so distant future, that there are dependencies that these people have that for whatever reason, if there should be a major shrinkage in the amount of Bitcoin out on the market, that they are going to croak. You know, if all of their customers were to tomorrow go to the window and cancel all of their contracts and try to take possession of whatever Bitcoin they actually accumulated there, that they would be completely fucked. And there isn't an FDIC, there isn't an SEC, there isn't anybody that could save them from that. They are going to find that one out. I mean, it's not something you can avoid forever. Anyway, I got this next thing here. It's on Wall Street Journal. Fed adds $72.8 billion to markets. Balance sheet moves to $4.07 trillion. Moves are aimed at ensuring that financial system has enough liquidity. This is by Michael S. Derby, and it was authored December 6, 2019 at 12:32 p.m. Eastern Time. So yes, penis. Oh, wait a minute. Hold on. I might not be able to read this. I mean, it's got me listed in as who I am on here, so there we go. Read the full story. Come on, goddamn you. You sons of bitches. They're not going to let me read this fucking article. So, let's try something else. I'm going to copy the title. This is a neat little trick you can do. Sometimes an aggregator will have the entire article. Either that or the article that one of these websites with paywalls is relating to. A lot of times they're operating on the same bits of information. But let's see if it'll give it to us without putting us through Wall Street. No, it's just giving us the little bit that you can see without having to go behind the paywall. Let's get a little more creative here. Maybe. It's taking 2 forevers for this website to load. And of course it's probably going to relate right back. Yeah, it did. Fucking shit. Yeah, most of the time... Wait a minute here. Maybe this one will... A lot of times, like I said, there's other articles that relate to the information. I don't know if I actually want to read this one. Yeah, why not? This one's on governmentslaves.news. Fed pumps $4 trillion into markets. Federal Reserve Bank, oh, you sons of bitches. Just as soon as I started reading it, they have some big ass pop-up that comes up, and I can't. Oh, you bastards. It's not going to let me read this fucking article. They're going to make me read some other bullshit. There we go. The Federal Reserve of New York added $72.8 billion in temporary liquidity to financial markets on Friday. The intervention came via 3-day repurchase agreements, or repos. The Fed took all of the securities offered to it by eligible banks. Fed repo interventions take in Treasury and mortgage securities from eligible banks in what is effectively a short-term loan of central bank cash, collateralized by the securities. The Fed's money market operations are aimed at ensuring that the financial system has enough liquidity and that short-term borrowing rates are stable and consistent with Fed goals, with the central bank's federal funds rate staying within the 1.5% to 1.75% target range. The effective Fed funds rate stood at 1.55% on Thursday. The broad general collateral rate for repo trading stood at 1.52%, also for Thursday. The Fed has been intervening in markets in the current fashion since mid-September, when short-term rates unexpectedly shot up on a confluence of factors, the biggest of which stemmed from corporate tax payments and the settlement of Treasury debt auctions. The Fed has used similar operations for decades to manage short-term rates. Since the large intervention started, money market rates have calmed down. The Fed is using temporary operations to tamp down any possible wild moves while purchasing Treasury bills to build up reserves in the banking system. It hopes that by buying Treasury bills, the central bank will be able to cut back on repo interventions at the start of next year. The Fed also bought $7.5 billion in Treasury bills on Friday. Eligible banks offered the Fed $23.17 billion. The central bank currently expects to buy Treasury bills through the middle of next year. On Thursday, the Fed reported that its balance sheet had risen from $3.8 trillion in September to $4.07 trillion as of Wednesday. Some $208 billion in repo interventions were also outstanding as of Wednesday. Yeah, and apparently that continues on to WSJ after that, and I'm not going to do that. But yeah, that's really interesting. You know, they're having to pump in liquidity on both sides of the market just to keep everything afloat. And that's more or less what's occurring here. They issue the bills, and then they accumulate them. But I don't know. I think in the longer term we're going to see that more stimulus is required, and that eventually, this additional liquidity coming into the market is going to tap out, and we are going to see some inflationary effects on the dollar. You know, there's a couple other things going on the things that are on the balance sheet for the Federal Reserve note that have been kind of buoying its relative value of things. But I see these as being temporary in term. You know, that they are due to extraordinary events, and that in the not-so-distant future, these extraordinary events are going to get rectified, and once they do, you know, because either the area ran out of oil, or they lost access to oil, or something to that effect, and yes, I'm giving you a little clue there, then we're going to be noticing a lot more of this inflationary effect that's really going on out there. They're able to distort it a little bit, because the primary driver of it is the availability and the price of gas and oil. But when we see a bump in the retail price for those things, we're going to see the effects of that kind of ripple throughout the economy. And a lot of the a lot of the inflation that's been deflected by supply of oil coming onto the market, yeah, that's going to change very quickly. And so and hopefully it's after we're able to, make some new discovery of oil or some shit like that, but I don't know. I think we're kind of up in the air at the moment on a lot of that, and I think the available supplies that we're receiving right now, they're not going to be there in the future. They're not going to be as available, and so those inflationary effects that are being deflected by the supply of oil will no longer be there. Anyway, let's go ahead and throw back down into some music. I got some Tool for you here, Schism, here on Coin Metal. And that was Death Clock with The Gears. And so we are drawing to a close, but I got just one more, because I think this is pertinent. It's pretty short, and this thing's on cryptopurview.com. South Africa prepares new rules to stop crypto from being used to evade currency controls. And this is by Cash. No idea whether this is male or female, so I'm just going to say yes, penis, because, Cash. Anyway, this is authored on December 2nd, 2019. Reserve Bank of South Africa is planning to introduce a new rule regarding the use of crypto in a bid to stop their use to evade currency controls. The rules are expected to be put in place by Q1 2020. Local banks such as FNB have already started clamping down on virtual currency companies. Last week, FNB closed all business banking accounts for companies dealing in cryptocurrencies. Reason? Bid to control money leaving the country. Africa's second largest economy barely sidestepped a second recession in 2 years in the second quarter of 2019. The World Bank has cut South Africa's growth forecast for 2019 through 2021, citing weak investor sentiment. Individuals increasingly are looking to protect their wealth against the rand's devaluation, weakening economy, and policy uncertainty. Now individuals and companies are largely moving their money out of the country and investing abroad. Smart. To control this situation, the Reserve Bank puts a limit on the amount of money an individual can move out of the country. Currently, South African citizens can spend up to 11 million rand outside of the country. Of this amount, 1 million rand does not require any declaration. For the remaining 10 million rand, citizens require prior approval from the South African Revenue Service. Dude, they're just going to sidestep you. As a result of these limitations, an increasing number of South Africans are researching their options on how to move money safely offshore. This leaves cryptocurrency as the most popular method of sending money anywhere in the world. South Africans' love for cryptocurrencies and Bitcoin is also apparent from the Google Trend results. Community reaction: South Africa's largest blockchain community, SA Crypto, said it had previously written to the Reserve Bank urging to adopt progressive statutes when approaching crypto assets. As per SA Crypto, conservative regulations would not only hinder innovation in South Africa, but also repel investment into the country. I think that second part is the bigger threat. And this is an aspect of cryptocurrencies that I think a lot of companies have been overplaying. Or countries rather. They think that they're going to put some sort of pressure on people participating in cryptocurrencies via taxation or regulation or any of that other shit. But the problem that these people face when they're putting this stress on the crypto community is that crypto is designed for evasion. It is designed specifically to be able to evade. Now, with that being the case, the reality is that the more pressure you put on it, the more people will seek to utilize that capability of cryptocurrencies. The more you let off of it, the more you simply ignore what's going on with regard to cryptocurrencies, the more of the money that is coming into the crypto economy will be circulating within your local economy. And that's just a plain reality. Plain and simple. You want to get the money to come in, you got to make it friendly. Because we do have the option of whether or not we want to deal with you. And you could put in all the fucking laws you want. It's not going to change what's going on here. In the longer term, it will simply hasten the migration of people to cryptocurrencies and seeking to create crypto-only economies that completely divest themselves of your fiat currencies. So if you want to retain what little control you do have of your economy, back the fuck off. Ignore us. We do not represent enough money in the economy, in the global economy, to be worried about. What you really have to worry about is your own policies. This just means that you can't just employ whoever the fuck you want and pay them however much you want. You actually have to play by the books. And I know that sucks to be accountable to anybody, but you know what? We are accountable to you and your actions. So if you start abusing the economy by having lax monetary policies, we are going to shop around for other options. And they do exist, whether or not you want to admit that. So the chore now is to be better. You have to be better than us. And that doesn't mean just be more appealing because of the lack of regulatory craft and discrimination and whatnot you enforce on people. Because the fact of the matter is that technology, the hardware that we have access to, is only getting more sophisticated. And as of 2009, we were able to create global monetary systems that were able to transmit money from one person to another anywhere, anytime on consumer grade hardware circa 2009. This is 10 years later. And again, like I said, hardware has only gotten more sophisticated. Software has only gotten more sophisticated. And that trend is going to continue regardless of what changes within regulation. So the way to get ahead of it is, again, simply ignore it. Soon enough, if you're a politician or whatnot, people will be offering you campaign contributions in cryptocurrencies. And then you will know that it has reached high enough saturation that you yourself could use it for just that purpose. And then it will be time to not worry about it, but participate in it just like everybody else around you. And it is with that I'd like to draw this episode to a close. Thank you very much for listening. I certainly do appreciate the support. We will be back again on Monday at 8 p.m. Pacific Standard Time. And so until then, I want y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. As far as our last dance is concerned, I have not picked one out, as usual. Let's see, we got about 5 minutes or so left here, so I think we're going to have to go with a little bit of clutch, because we haven't played any of that, and so here it is. Escape from the Prison Planet. Last dance here on Coin Metal. Thank you again for listening, and you all have an excellent weekend. Good night.